Monro Muffler, MNRO is the ticker. So this is an auto service business. They do like general repair, mostly tire replacement. That's like half the business. Steering, brakes, other things like that. 1,200 locations, 1.2, 1.3 billion in sales. So this is a pretty big player. Just for reference, there's a PE-backed competitor who's rolling up the industry. They're probably at like 3 times the location count. So that's the industry. It's a pretty solid business, right? Like if you need something fixed, you're going to go repair it. It's pretty recession resistant, and it plays to the same trends that like the AutoZones and O'Reilly's have: aging vehicles, miles driven, etc. So auto repair, that's the basic backdrop for the business. The stock has been an absolute dud. I mean, $70 in 21 down to, it was 10, 12. Now it's like 15. And so why is this thing interesting, right? Oh, here you can see all the brands they've got, right? So 1,200 locations in a whole bunch of different brands, which I don't know if that's the right model. But anyway, why is this thing interesting? Well, the thing that caught my attention here in March 2025, so just a couple months ago, they abruptly fired their CEO and brought in a new CEO, Peter Fitzsimmons, who's managing director of Alix Partners. And Alix Partners specializes in like restructuring turnaround work. So this is pretty fascinating, right? You have a board who's pretty much fed up with the old executive, makes a hard change in bringing in like a restructuring-oriented person to run the company. And so my quick read on that is they want someone who's willing to come in, move fast, and make hard changes, like hard pivot in the business. And an external new hire is probably going to take their time, assess things, etc. So this is going to be like quick and maybe some of the more painful actions being taken. Second, I think that it feels like that's an indication that they want to fix this and sell the company as opposed to like teeing up the next executive to run the business for 5-10 years, right? So you've got an external person coming in basically as a consultant to run the company. So I just find that pretty fascinating. And I did this quick value write-up, and then 2 days later they reported earnings. So I didn't have a chance to digest, or I'm now digesting it, but we'll take a look at that. So that's the catalyst here. If you're a believer in, external management hires or management change as a special sit category, then you could potentially put this in the special sit bucket. So that's the backdrop. Decent business, turnaround CEO coming in. The fundamental picture here is really not bad. I mean, this is a pretty decent business. So let me pull some of this off. So here's your revenue growth picture, year-over-year revenue growth. And for years, this thing was like a 5 to 10% grower. This was at one point in time in that like compounder bucket. I think the Sequoia guys owned it. Roy and Cunniff, those guys. So this was like a really well-regarded company. And then COVID happened, and it's just kind of fallen off the rails since then. So you've got 3 straight years of revenue decline here, 4 of 5 with 1 snapback post-COVID. So it's like been kind of punky. And this was a roll-up story for a long time: acquire smaller shops, tuck them in, pick up the financial benefit, etc. And so they got away from that. I don't know what the story is there. Let's just tighten this up a little bit. Look at the cash flow. So you can see this is a pretty good cash flow business, right? I mean, even today it still generates plenty of free cash. And if we look down here, here's the acquisition line, right? So, still acquiring stuff all the way up to 2022, and then just came to an abrupt halt. Maybe it wasn't working, whatever. And now they're actually selling assets off. So they've gone in the opposite direction here. And now most of their cash flow is going to pay this dividend, which is like $34 million, $35 million bucks a year, and then pay down debt. They had a brief period where they were doing some buybacks, but that was pretty short-lived. Now they're paying down debt. And candidly, I'll admit this has lease accounting in it. That's, I think, right. Let me pull it up. Where is it? It's got finance leases, which I think is just the absolute worst. Where is it? Here we go. All right. Balance sheets. So they've got finance leases, right? 250 million. This is as of March 31st, 2024. So this is stale. Don't use this. But finance leases, so the you split that out between op cash flow and financing cash flow. So you can't really take the 125K operating cash flow and 125 million and 25 million and call it a day. Like, you got to bake in your, and of course to make it even more obscure or hide it a little bit, they just bury the principal payments on finance leases into the financing cash flows. So you really have to treat that like debt, right? And they'll tell you, here's the new finance leases created or reduced. So they've been doing a good job of chipping away at these and like not using it as a capital mechanism, but it makes the accounting a little bit wonky. So it's not as clean of a free cash flow number. So caveat there. So new CEO came in, profitable company, pretty low leverage. I think in my write-up I have, where is it? Net debt is 320 million with the finance leases included, right? So we saw that they've got, 100 million-ish of free cash. And they're getting some working capital benefit from those revenues declining. So new CEO came in immediately right out of the gate, going to close 145 stores. So like 10% plus of their location count getting closed. So that's one point. Second point, here's your quarterly comp sales, right? Finally starting to turn the corner a little bit. And then here's the monthly view, and this chart's kind of horribly laid out, but the blue, right, really we want this last 5 months, -2 year over year, +2, +8, +7, +6. So you've got some comp sales trends working in your favor here. And it sounds like that's continuing into the quarter. So I think that's a positive, right? You get kind of the wind behind your back as you're trying to fix things up. And then last, they still expect to generate a decent amount of cash from working capital inflows, right? So, where is it? Store optimization plan, reduce total sales by 45 million for those 145 locations getting closed. It'll take them 10 to 15 million to execute on that. They expect to deliver positive sales growth, right? But gross margin will continue to remain pressured. So, and generate sufficient operating cash flow to maintain their strong financial position and fund all capital allocation priorities, including the dividend. CapEx is 25 to 35 million. So pretty much a continuation of where it's been. So that's pretty interesting. Like it's like a turnaround, but not in distress. So I find that fascinating. The new CEO came on, had the call, said all the right things. Let's see if I can find this. 4 key areas of focus, comprehensive review, 145 stores to close. I don't know why they hadn't been more pressing about closing stores in the past. They've been talking about fixing underperforming stores for years, and only now that this guy came in, they're actually going to do something about it. Generate 5% of total sales. You have what, 10 to 15% of your store base generating 5% of your sales? That's pretty wild. And they think they can recapture some of that. So in their other locations that are nearby. So customer journey, focused on that. Customer acquisition. So they're trying to figure out who their target customer is. Highest value customers deliver 25x more profit than their lowest tier of customers. So it's like maybe they kind of losing their identity along the way. So the guy feels like he's focused on all the right things. So it's really, really early in this, and he hasn't laid out any of the math behind where they can take this thing, right? So you're still leaning on your historic fundamentals here, which, let's see, positive cash flow, continuing positive cash flow, although benefiting from working capital. Huge caveat. Benefiting from working capital, positive operating income. You got the leases, so you got some interest expense on that. So you've got positive earnings here, right? Positive earnings, excluding these restructuring charges, positive earnings. So it's profitable, not crazy levered, but it's also not really cheap, not really that cheap. What did I pencil it out to? Let's see. Koyfin has it at like 18 times forward earnings, but let's see. Free cash flow expected to continue benefiting. I got owner earnings, so just net income plus D&A minus CapEx at about 30 million or $1 a share. So at 15 bucks a share, 16 bucks a share, it's not crazy cheap. But I think what you're playing here is, can we fix this and sell it, or can we get EBITDA margins back, 500 basis points better, right? So the upside math is maybe hard to pencil out, but that may not be the point, right? Because you don't know how much improvement could potentially be made in a situation like this, especially where the balance sheet's already pretty decent. So anyway, I don't know that I have a good feel for what the upside target looks like and when. I think that's what I'd like to do some more work on. I don't have a position in it, but I like this story. It's like a turnaround. It's like an interesting turnaround with an interesting turnaround CEO in a like non-distressed, not back up against the wall kind of situation, which if you're playing that kind of a story, like you'd rather be playing from a hand of strength, which that's how this feels. So if you got comments, let me know what you think. Check it out, valuedon'tlie.com. Thanks.